Thank you. Welcome, everyone, to issue 2022-13 of Tax to the Max, the 13th Thursday in 2022, the last Thursday in March. Here's the disclaimer. We read that fairly often every week. The thing I want to really emphasize is the value of my subscription to Tax Notes today. I couldn't do this program without it. I couldn't practice without it. Tax Notes Today is published by tax analysts, in my opinion, the preeminent source of current information for tax professionals. The wonderful thing about tax analysts is they are totally independent. They are not part of a multinational corporation like a couple of the other tax services. They're strictly dedicated to making sure that tax practitioners in the United States get information that should be available coming out of Washington, and that they're not allowed to hide their stuff. They've litigated a lot of things. The reason that we can have private letter rulings today is that tax analysts 30 years ago sued the Internal Revenue Service to force them to be disclosed. What do we have? 10 other items. Tax Matters partner cannot muzzle the IRS. They get to talk to your partners. Why do we still need guidance on Public Law 86-272? And you might not even remember what that is. That's the original multi-state taxation rule that was litigated back in 1980s, and then Congress took action in 1986. Individual return filers are going to be required to answer the cryptocurrency reporting question on their 2021 returns. The IRS, the 2021 returns. The IRS does not agree with an exempt relocation benefit ruling coming out of the 11th Circuit. The 11th Circuit gave a taxpayer favorable ruling. The IRS doesn't agree with, which means that anyone else who wants that same treatment is going to have to look forward to litigating it with the IRS. When is crowdfunded money taxable? I've been trying to figure out something that I could sell to the general population that would get them to crowdfund me. I need to really think about a more comfortable retirement. I think I should retire with a valet and perhaps with some personal services, but I don't have enough money for that. So perhaps maybe I could get 1 million people to send $5. Would that be income? We'll think about that. Fast track ruling requests. I've been telling you about that now for the last 3 or 4 weeks. We are actually getting the promised fast track treatment on a ruling request on a corporate matter. Then we have the IRS updating the guidance on the exclusion for unemployment compensation in 2020. Some of us are filing amended returns, necessarily so. And then I have I'm sorry, there's some sort of a background noise. I think they're working on the building next to mine. Let me turn it off. Should non-deductible pot expense increase the business owner's basis? Good question. And then the court denies a penalty safe harbor, but that's not the whole story, and the head note is misleading. And as part of this series of programs, I want to make sure that I share the benefit of 40 years in tax practice, the lessons that I have learned the hard way when I see opportunities to share those with you. And this is a head note that's, it's the headline about a decision that simply doesn't tell the whole story and could mislead you. Finally, a practice unit. We talk about those every time the IRS publishes a new one. This practice unit explains the penalty for filing an excessive refund claim. Filing a claim for refund that is not justified can get you a 20% addition to the tax that's ultimately due. Well, that's a heavy menu. What do we got? Well, you cannot muzzle the Internal Revenue Service. The Internal Revenue Service can question your partners without you. I really apologize. There's something crazy, some crazy noise. Let's go back a notch. This is Oconee Landing Property LLC. It's a tax shelter. The IRS is onto the scheme, and they're sending letters to the limited partners asking a few questions. The promoter is objecting to that. Judge Slauber says, you can't stop the IRS from talking with your limited partners. But what do you suppose the IRS is asking those people? I'll tell you what. They're asking what representations were made to you before you made your investment, and who told you about the benefits of this investment. Were you hustled by a lawyer? Were you hustled by a CPA? Were you hustled by a promoter? The IRS wants to find the person that promoted you into this deal, and then they want to examine your motives. Unless your motive was purely to make money, if your motive was to get a big tax deduction, and that's all that you were told by the promoters, and that's all you expected, guess what? Not only are you going to have problems with the IRS, the whole deal is in danger of collapsing because the IRS will simply the balloon. Public Law 86-272, and I found this wonderful cartoon of this poor guy is running around with a blindfold. What do we still not understand about taxing multi-state business operations? We had National Bellis Hess, which said you look at three factors. You look at payroll, you look at the capital investment, and you look at sales. And those three factors, and we'd maybe adjust them for weight, but that's how you determine whether or not a business is taxable in a particular state. And then along comes Quill, and we began to litigate the question of whether or not just having sales in a jurisdiction was enough to have nexus. And then we had a series of cases. We didn't even have to have sales. We had a business presence. We had a loan company, a bank, that was soliciting credit cards in, I believe it was either maybe West Virginia, soliciting credit cards in West Virginia, and they were found to be doing business in West Virginia simply because they solicited credit cards and they had an 800 number. And so this has been continually changing until today. We have the Wayfair decision, which says it can be just sales. So it can be a business presence and it can be just sales. Now, can I turn that on its head and establish nexus in a state where I want to be taxed by making sure I meet one or more of these attributes, one or more of these court decisions? I'm not so sure. And neither are other people who are beginning to write about this in the wake of Wayfair. Wayfair is not the be all and the end all, but the question now is, I want my business to be located in, I want nexus in a low tax state. I do not want to be taxed in a high tax state. And so not only will I put my warehouse, my distribution center in a low tax state, I may decide I will not mail solicitations in a high tax state. I'm going to have nothing to do with your state. The tax rates are so high, I won't even advertise an 800 number in your state. And that way, even Public Law 86-272 protects me. Interesting thought. The IRS will have information on your crypto dough. Information release. All taxpayers filing Forms 1040 are going to have to check either the yes or the no, one or the other, in response to the question at the top of the form about virtual currency transactions. This release lists the criteria by which taxpayers may check no or must check yes. You must answer the question. At any time during 2021, did you receive, sell, exchange, or otherwise dispose of any financial interest in any virtual currency? At any time during 2021, did you receive, sell, exchange, or otherwise dispose of? You'd think that would take care of it. If you didn't actually transact any business, that you could avoid answering the question. Not so. If you're filing the Form 1040, you must answer the question, not just taxpayers who engaged in a transaction, because the question is misleading, and that's why I'm bringing it up. When can a taxpayer say no? I owned virtual currency, but either I did not engage in a transaction, or my activities were limited to holding the currency, transferring the currency between my own wallets, purchasing currency, using real currency, not exchanging. Now, if I change one virtual currency for another, that's a reportable transaction. And this includes purchases using PayPal and Venmo, or engaging in a combination of holding, transferring, or purchasing virtual currency, any combination described in that list, okay? Now a taxpayer can say no if that's you. If this is you, you must say yes. You received virtual currency as payment for goods or services. Boy, that should be a no-brainer. But you receive virtual currency without providing any consideration, but it doesn't qualify as a bona fide gift. What? Could someone have given me virtual currency for my place in line? It's not goods. It's not services. It's an intangible right. So the IRS is covering all its bases here. New virtual currency is received or created from mining and staking activities, and you need to read those definitions. Virtual currency is received as a result of a hard fork, and that is a split where you receive, think 2-for-1 split. You had one unit, and as a result of a hard fork, you now have two. That's taxable. You got an exchange for property, goods, or services, any other disposition of a financial interest in virtual currency, and you must check yes. When in doubt, wisdom says, check yes. Code section chapters 21 and 22, those are two different chapters in the Internal Revenue Code. Chapter 22 is the Railroad Retirement Tax Act. Chapter 21 is FICA, the Social Security. So 3201 is the same as 3101 in setting up. 3101 sets up Social Security. 3201 sets up the Railroad Retirement Act. Now, obviously, this is at a time when their railroad workers were a special class, and I guess there were more of them then than there are now. But this differentiation survives in the Internal Revenue Code. So today, a rule for one is probably going to be the rule for both. At least that's what I think you should expect. The 11th Circuit has just said that providing relocation benefits for a railroad employee will not be subject to Railroad Retirement Tax Act tax. The same should be true for FICA. The employer provides relocation benefits. The relocation benefits should not be taxable. The IRS says they should. The judge got it wrong. Now, when the IRS takes an action on decision like this, you can look that decision up, and the 11th Circuit has a ruling, but you can't cite it as precedent. If you don't want your relocation benefits to be subject to Social Security tax, you're probably going to have to litigate it yourself. Crowdfunding proceeds may be taxable. This is a fact sheet. The threshold for reporting money raised through crowdfunding is $600 beginning in 2022. That's down from $20,000. So the IRS is awakened to the fact that they may have been missing a lot of taxable income. Money raised will be taxable as income if contributors receive goods or services. Contributions made as a result of the contributors' detached and disinterested generosity. That's what I'm looking for. I'm looking for the Aging Accountants Retirement Fund, which benefits me. And I want crowdfunding for this. That would not be income because the contributions would be made with no expectation of any benefit or service. But the payment processor still has to issue a 1099-K, and I still have to account for it. I have to explain it. There's no circumstance in our tax system where a whole lot of money is going to float around unreported and untaxed without heavy-duty explaining going on. The letter ruling here, letter ruling for a corporate letter ruling may not be free, and they aren't, but they can be quick. This is an article by Chandra Wallace reporting that most taxpayers submitting requests for corporate letter rulings in the 2 months that the IRS has had this fast track program underway have been accepted into the fast track program, and processing is taking place within 12 weeks. This is a really big deal. Some of us that have submitted ruling requests over the years have waited as long as 9 months to even get a letter from the Internal Revenue Service acknowledging that they have assigned our request to a group to give us a ruling. So this is a really big deal. If you've got a transaction, a corporate merger, or perhaps you've got some kind of a disposition, and you need to nail down the tax ramifications, and the client wants a ruling. They don't just want your opinion, and you've got a transaction that's held up beyond any reasonable economic concerns. This is really important. Big deal. Unemployment compensation frequently asked questions are updated. Fact sheet updates the list of FAQs, adds one FAQ on eligibility, corrects a mistake, and clarifies answers to several other questions. The index is here. The fact sheet lists this information that I've given you here. Question number 6, new question on eligibility. In topic D, questions 1, 2, and 4 relate to an amended return for what? An amended return on unemployment compensation benefits. Topic E, one question, the impact of unemployment compensation benefits, taxable or not, on income, credits, and deductions. In topic G of the original fact sheet, 3 questions, 1, 8, and 9. What to do if you receive a refund, a letter, or a notice? In topic I, 1 question, post-unemployment compensation exclusion adjustment. Did the IRS get back to you, or did the state get back to you and adjust your unemployment compensation? And you have to give some money back? That's called a claim of right. You thought it was taxable and it wasn't, or you knew it wasn't taxable, but you thought it was, you made a mistake. Correcting mistake is different from giving money back that you thought was taxable, but it really wasn't. Finally, in topic J, 1 question, the effect of unemployment compensation on your economic impact payment. All you need to know that might require an amended 2022 return for your client that got unemployment compensation is now contained in this updated fact sheet. If the expenses incurred in conducting a marijuana business are not deductible, then should they increase my basis? That's a legitimate question. You're not going to let me deduct them. There are other areas of the law where an expense that is not deductible increases my basis, but this might be unique. We got a long shot, I think, theory claims that deductions denied to state legal marijuana companies don't evaporate, but get into the owner's basis in a business. Maybe you're paying expenses of operating the business to add value to your business license, or just to add value to goodwill. Those are capital assets. But denial of the deduction is intended to deny any offset against taxable income by an expenditure relating to growing, buying, selling the weed. But selling a business is not the same as selling the weed. It's different. So if you have a mind and an inclination to discover how many angels can dance on the head of a pin, you might want to take this issue up on behalf of a client with the IRS. Some of us have clients, some of us don't. Some of us have avoided any involvement with the marijuana business until it straightens itself out. But some CPAs have clients in the pot business, and they're doing a good job of representing them. This may be something that you want to take up against the IRS. If you don't ask, you don't know what the answer will be. The problem I have is if you allow an increase in basis, that assures a tax benefit, which is what Code Section 280E was intended to deny, which is any tax benefit from money you spend in the marijuana business. Now here we go with a misleading head note, which is simply not the whole story. Here's the head note. Penalty safe harbor can't save late resubmission of info returns. That's a quote. A safe harbor for de minimis errors can't excuse a tax reporting company's failure to timely resubmit more than 20,000 information returns that the IRS's electronic network originally rejected for containing an improper dash. One iota, an improper dash. Louisiana District Court concluded that safe harbor won't excuse the de minimis error. Well, I was up in arms. What a overbearing. Wait a second. The code section they were trying to take advantage of was enacted 2 years after the due date for those information returns. So the code section they're looking for really wasn't even available. But wait, there's more. The penalty is $579,000. Did anybody see the magic words in what I just read? Tax reporting companies' failure to timely resubmit. Okay. Improper dash, resubmit. That's different from submit. If I file a return on time, since when am I not permitted to correct an error that has absolutely no effect on income? So we got this misleading head note. Here's the citation, RSBCO versus USA, Louisiana District Court. They dismissed some of the company's 6 claims, but they refused to deny claims regarding the 8th Amendment that the $579,000 was excessive and the authority to impose penalties for late refilings. IRS has no authority to impose a penalty for late refiling. They have no authority to disregard a form that is filed on time with a foot fault, with something, just a clerical error. It's not the same as the original filing, and the IRS is making it up as they go along. The court went on to say, those arguments, the excessive fine argument and the refiling is not the same as the original filing, those 2 arguments require a review of the evidence. So get your acts together, lawyers, and come and see me. That's hard work. A new practice unit. Hopefully you don't get involved in this. This is a practice unit for how to calculate and how to assess the penalty against a taxpayer who files a claim for refund without proper support, and the claim for refund is denied. This is I think these are quality control issues myself for our practice. There are 267 of these practice units that have been published between 2014 and today. You can find them at the IRS website. Just search for practice units. Going back just 2 or 3 years, there's a whole series, and you can't tell exactly what's in there from the title. You may have to look at from the title that's in the index. You may have to bring the practice unit up and look at the title that's on there, but there are at least 4 that discuss partnership basis, partnership capital accounts, and how to determine the effect of a distribution on a partnership's income. There are at least 4 that I'm going to be talking about at Spring Splash and I'll cover at Spring Splash, that talk about S corporation shareholder basis, and they're in the AAA account and the other adjustments account and how all of that works. So this section 6676 penalty on erroneous claim for refund, this is guidance for the IRS examiners. And here I found the IRS examiner needing guidance in front of a computer with Post-it notes up on the side, kind of like mine, right? And a book that says Programming for Dummies. I don't mean to impugn the intellectual ability of the IRS, but there it is. It's a cartoon. It explains the procedures for erroneous tax refund or credit claims, a detailed explanation of how to assess the penalty, the criteria that have to be met for the penalty to apply, and any exceptions to the penalty that the IRS employee should consider before they assess it. 24 slides. It's easy for us to follow this stuff. So, folks, if you have a good time here, if you learn something here, let's continue to meet every week, Thursday at noon. This short call will feature current information about developments, sometimes in South Carolina tax law, sometimes federal tax law. Sometimes we have a guest. Sometimes we may go as long as 45 minutes or so, but never more than an hour. Thank you. If you have questions, send them to the email address. I'll do my very best to help.